Hello, welcome to a presentation on optimizing trading tactics. This video will demonstrate how by standardizing your methods you can enhance your trading and make it more effective. My name is John Slazis, founder of JSServices Research and Trading LLC, an independent 30-year veteran technical analytics firm. Markets have changed from the behavioral trading of the pit to the quantitative high-frequency trading of the screen. In this video, I will show you the steps needed to make your discretionary approach more systematic and improve your competitive edge in an increasing algo-dominated landscape. A discretionary trader's edge is their ability to make intuitive decisions, the fluid, no-hesitation execution of a trade plan, a complete in-the-moment focus where actions are consciously observed and intuitively executed. Some refer to this as trading in the zone, which is the goal of performing any action at its highest level. To achieve this, traders must have good awareness and a fact foundation that defines the context of the current condition. JSServices provides this foundation with its quantitative analytics that offer a macro strategy to standardize trading tactics, which can be enhanced with JSServices application integrations that integrate microdynamics and real-time order book events into your workflow to improve intuitive decision-making. JS Analytics serve as the basis to standardize trade plans by providing context to create a more systematic trading approach. Standardize, to cause to conform to a standard. JS Analytics are the standard to align trading tactics with to create a more systematic approach that is unified across all markets and state conditions. It does this by presenting a comprehensive definition of a market state, price structure, and inherent strategy themes. JSServices Market Color State Analytics provides traders with an unbiased, fact-based resource that objectively defines the current market state condition. This fact foundation provides context to align trading methods and create a more systematic, sustainable trading approach. Context: the interrelated conditions in which something exists or occurs, the environment or setting. Market state defines the environment in which the drama of the trading day occurs. This provides a foundation or context to the trade period. Market state should not be viewed as the definition of a long-term general technical condition, but rather the characteristics of price behavior that should be anticipated to occur intraday during the trading session. Market Color is an objective resource which offers a quantitative definition of the current technical environment or market state. Market Color is not a subjective forecast of what the state will be, but rather a comprehensive insight into what the context of the current market state is. Without context, trading decisions become guesswork, as there's no basis or benchmark to define why a tactic worked one day and not another. No matter how disciplined and refined a trading tactic becomes, without a supporting contextual or strategy foundation, it is unlikely to be sustainable. Only when tactics are aligned with a strategy foundation is there the basis for real success. This foundation for success is explained well by Chinese philosopher Sun Tzu in the classic strategy guide, Art of War. To paraphrase, a trader that masters a trading tactic will find small successes that will keep their dreams for a big payday alive. But without a strategy foundation, over time their methods will ultimately falter. Traders that have a strategy foundation, however, will be able to build a sustainable trade plan, which can be optimized by combining trading tactics to create lasting success. Market state is that strategy foundation. JSServices Market State Analytics are a quantitative indicator whose design is to identify the characteristics of the market state to present the context of the current condition. Not a subjective forecast model of what may be, but rather an objective fact of what is. This fact foundation provides the basis to create a more systematic execution of a trade plan and a sustainable approach. Real clarity comes in understanding the characteristics of the environment, the nuances and tells that make each market state unique. The better the clarity, the easier it is to get in sync with the market. Typically, this clarity comes at the end of the session, when looking back over the chart in hindsight, the opportunity was obvious. With good market state awareness, this happens in real time, When trading tactics are standardized to the market state foundation, a trading program becomes sustainable. Most traders view the market as binary, black or white, trending, non-trending condition. JSServices adds color and creates a picture by classifying 26 unique signature state conditions. The market color bias provides deeper insight into the characteristics that should be anticipated to influence price action. This awareness provides clarity in determining when market states are changing, so tactics can be optimized by aligning with real-time events. Every trader has experienced each one of these market states at one time, but are typically not aware of it till after the fact. By having this contextual awareness prior to the trade session, trading tactics can be systematically aligned and price behavior anticipated in real time, improving intuitive decision making. Market color analytics identify the facts associated with the current market state and its unique characteristics. These characteristics provide insight to how price action should behave within a session, so tactics can be aligned to optimize performance. Trading tactics can be standardized by aligning them with complementary market state conditions and normalized into your workflow using JSServices desktop application. Using a bull trend correction as an example, the desktop application can be used to quickly identify markets that are in this market color bias. Here we have the NASDAQ, and by clicking on each tile it identifies the market, and we can see that this is a bull trend correction, and the color coding allows you to quickly see other markets with the same state. This is nice because when you standardize your tactics to a bull trend correction, you have this expectation, and these are the attributes of that expectation. Markets in a bull trend correction have produced a negative signal against a positive trend, so we have potentially sharp breaks that don't follow through and bounce back. And we could turn into kind of some sideways chop, but the market can also start to revamp that bull trend. And so this is our expectation. Momentum is going to be choppy, kind of sideways rotational, more range trading. We do have more of a negative bias because we're corrective, and we could see volatility decrease. So let's take a look at the NASDAQ. So here we can see the NASDAQ for the session. Again, we're aligning our tactics with this expectation. And here the market performs to expectation. We have a market that's basically sideways. We're getting the market the bull trend tries to ramp up, sharp break against it. Tries to ramp up, sharp breaks against it. This is the expectation of this state. We're not surprised when this market doesn't follow through, and we're also not surprised that these breaks aren't following through. 17th of March is this example, and the FTSE is also in a bull trend correction. And here we see the market opening soft, getting the buyers interested, and then having this sharp sell-off. Again, more stop and go action. That's the expectation. We're improving our awareness of the market state to align our tactics. Market color, more than anything else, is an awareness tool that provides clarity to what the current condition is, so trading methods can be optimized by aligning tactics with these facts. It's important to stress that in contrast to a subjective forecast, the basis of the market color state analysis is to present an objective fact-based truth, to improve awareness and provide a foundation to create a systematic trading approach. JSServices price map analytics identify the structure of the market state and offer a price framework to standardize your trading. Structure: something arranged in a definite pattern of organization. The analytics define predictive price levels that identify the points where shifts in market state occur. Every market state has an expectation that defines it. The expectation of a bull trend is a market that is trending higher, making higher move highs and higher move lows. The price map is the structure that outlines the boundaries which make the definition of a market state true. They are the price points where the market state will either hold structure and persist, or break structure and transition. As the market moves up and down during the trading session, making sense of price action without any structure is a challenging task. The price map provides this by defining the structure of the market state. Real clarity comes from observing price action within the price map structure in the context of the market state. The JSServices price map is not a series of subjective technical support and resistance levels. The price map is a quantitative price framework that defines the structure of the market's technical state. In a general sense, market price action is in a constant state of expansion, trending, and contraction, non-trending. The aspects of the different types of trending and non-trending movement can be classified into unique conditions or market states. Transition market states occur when the expansion or contraction reach a zenith in the varying degrees of the ebb and flow. It is at this moment before the market continues to expand or contract that is considered to be in a state of dynamic equilibrium. It is these points of equilibrium that define the structure of the market state. JSServices quantitative algorithms identify these points of equilibrium and present them in a structured price map framework. It's at these points of alignment where liquidity is the highest, risk is the lowest, and opportunity the greatest. Traders are able to anticipate opportunity at key price points and create risk-defined strategies with improved trade vision. The structure provides a basis to standardize trading tactics and create a more systematic approach. It is important to understand that these are not a series of subjectively defined support and resistance levels, but rather a set of quantitative technical levels organized into a framework that provides an objective structure that defines the context of the market state. The real value of the price map is the insight it provides by how a level is qualified. The levels are divided into three groups: directional levels, validation levels, and target levels. Price map directional levels define the foundation pillars of the market structure, which are the critical range bounded by the UP upside pivot and DP downside pivot, with the directional the midpoint pivot, and the R level, which identifies the sentiment bias for the market state. The directional levels are the boundaries that define the market state and structure bias. Awareness is improved by monitoring price action to know if structure is holding, which indicates that the state characteristics will persist, or is breaking structure and transitioning to a new state. Aligning trading tactics with the price map directional levels standardizes methods with the structure that defines the market state. This improves the ability to intuitively anticipate opportunity and offers a framework to create a more systematic approach that is unified across all markets. Validation levels are part of the price map framework and are also referred to as minor levels. These market structure points are used to confirm or validate momentum trends and changes in market state. As the price action in a trade period either violates or is sustained by these levels, specific insight in terms of confirming a shift in momentum and the transition to a new market state can be made. The validation levels can also be used for position management within a trade strategy by observing price action within the price map framework. Price map target levels identify the magnitude of the expected price change in an extension of momentum or shifts in market state. By observing the price action through various target levels, deductions can be made regarding the strength of market momentum, which determines the degree of change in market state. Target levels can also be used for entry, but are best suited to standardize exit targets from the DIR, UP, and DP breakout signals. Here's an example of a market in a bull trend with the sentiment bias R level below the market and the price framework overlaid on the chart, with directional levels, validation levels, and target levels. The directional levels shown form the boundary of the critical range and are also action levels that represent the best place to initiate a trade to participate in the bull trend. In this example, with the market opening above the directional, it marks this price as the higher low in the positive structure of a bull trend. If the market is going to continue to trend higher and perform like a positive trending market, then it will maintain a trade above the directional. If so, the UT1, or upside target 1, is the target expectation for a trade initiated from this level if it follows through. The other opportunity is a breakout above the upside pivot, or a critical range breakout whose target is the UT2, or the upside target 2. The validation levels offer a framework to show that the market is indeed trending higher by violating and maintaining a trade above successive validation levels. When the market stops holding this market structure and cannot maintain a violation of a validated level, it is a sign that the trend may be over or that it's due for a pause. Monitoring price action within the price map market structure in the context of the market state provides clarity so opportunities can be anticipated. The context that the state and structure define offer a foundation to standardize trading methods and create a more systematic approach. If a market holds structure, then align trading tactics with the characteristics of the state. If the market breaks structure, then alter expectations and anticipate a change in state. JSServices playbook analytics provide a strategy theme of what to do, and the price map defines where to do it. Here we have a market in a bull trend, and price action is below our sentiment bias, or R level, which is our point of equilibrium for the session. And here we can see that the market is clearly in a hedge strategy theme. It has broken structure, making the optimal strategy theme not true. The bull trend has broken structure. It's no longer in a bull trend. It's in a hedge strategy theme, and we should align our trading tactics to that fact. Real clarity comes when we see that the market has broken structure, and we know that the conditions are changing, and we can align ourselves with the proper strategy theme and participate in a corrective move against a bull trend. JSServices Market Strategy Analytics provide the basis for a systematic trading approach that is unified across all markets and asset classes by offering a strategy playbook that identifies the ideal scenarios or themes that are more likely to occur in a trade period. Strategy: a careful plan of action or method intended to accomplish a specific goal. JSServices Market Strategy Analytics provide a fact-based strategy guide to the opportunities that are most likely to occur as the result of the current market state and structure dynamics. How it works is that the Market Strategy Analytics interpret JSServices market color and price map results and determine the best opportunities for the trade period based on the unique characteristics of the market state and structure bias. If a market is in a specific state with a specific structure, then it will have a specific strategy theme associated with it. The results of all 26 market states, each with 9 structure bias skews, have been compiled into a database of 234 unique strategies or plays. The strategy foundation begins with a market state, each condition having its own unique characteristics which represent the price behavior that makes the definition of the state true. For example, a bull trend is defined as a market that's making higher move highs and higher move lows. This is the characteristic of price behavior that defines a positive trending market or bull trend. The optimal strategy theme for a bull trend is to participate in opportunities that align with these characteristics, or to trade from the long side with the ideal entry point at the higher low structure, as this will offer the best optimal risk reward. The price map structure defines the price framework that makes each state definition true, offering specific action levels to execute trade tactics to capture optimal strategy theme opportunities at ideal risk-defined areas. Markets are in constant state of change from one state to the next. A signal that a market is transitioning is when there's a break in structure. As with the optimal themes, which identify the best strategies for when the market holds structure, there are also ideal scenarios when the market breaks structure and is in a state of transition. These hedge strategy themes are also presented in the playbook with defined entry tactics which are ideal for capturing these opportunities. Both optimal and hedge strategy themes contain trade tactics which highlight the specific price map levels to execute an opportunity with defined risk parameters. There is no subjective thinking needed to decide what to do or where to do it. Just clear, objective definition of the themes that are most likely to dominate price action and a set of specific entry tactics which identify where to capture the opportunity. The playbook offers a foundation to align trading tactics and create a systematic strategy-based trading approach, which can be normalized into your workflow with JSServices desktop application and chart integrations. The playbook affords the ability to standardize trading tactics to complementary market states, offering a strategy-based versus a market-based approach. This allows traders to move into different markets that have conditions that support trading methods. As an example, we're going to take a look at the Italian long bond, the BTP. It's in a bear trend. Structurally, sentiment is above the market, which identifies optimal strategies to sell against this higher peak that keeps this bear trend true. That's the optimal strategy theme. It's logical, makes sense. And we're going to look for hedge strategies if the market breaks structure and we get a reversal or a break in structure that takes out that lower high and makes the bear trend statement not true and confirms a transitional trade. Here we're using our chart integration. You can see the price map levels are placed on the chart here. Great visual. And we can see that the market is trading below the directional, above the downside pivot. We're looking for what strategy theme might be in play. Currently the market's in a bear trend. It's moving lower. And here we're getting a failure below the downside pivot, so we're getting a downside breakout. The real selling energy is above the market, so that's why this is not a optimal sell opportunity. And here we get what's called a reversal, where the market breaks out to the downside and then cannot follow through and gives us a positive reversal signal, confirming this hedge strategy theme. So as traders, we're always observing price action within market structure in the context of the market state and the different strategy themes to identify what theme we're in. And here it's clear that we're in a hedge strategy theme or a buy DP reversal. And the market follows through. JSServices playbook strategy themes provide the foundation for a strategy-based trading approach that is unified across all markets and asset classes. The JS desktop provides a macro strategy which supports trading styles of any duration by improving awareness and offering a fact foundation to align trading tactics. From the fact foundation, the playbook analytics derive the optimal strategy themes and identify specific trade tactics, which can be optimized by incorporating microstructure dynamics with JSServices risk and reward parameters and order book events to enhance trading tactics and make them more effective. Optimize, to make as perfect or as effective as possible. The APMD, or average price map distance, is JSServices reward parameter, which identifies the price segment distance the market is trading in. This is the amount of profit that the market is paying out, and should be used as a metric to define the value of an opportunity. Markets typically trade in 1/2, ×1, and ×2 APMD segment moves. Trade target durations should be aligned with this fact. The risk parameters identify the surrounding acceptance zone in which opportunities are valid, as well as the boundary that defines the integrity of a price map level. The market metric boundaries are defined by the AD alert distance and VAR variance, and also include the maximum amount of risk that can be assumed or a maximum stop distance. The risk parameters can be used simply to identify signal acceptance. Note in this example that the accept buy signal arrow is larger than the sell, which represents the value of the opportunity due to the context in which the signal is occurring. Buy signals above sentiment have a greater value than sell signals below sentiment in a bull trend market state. This fact offers a systematic approach to allocate size by differentiating the value of an opportunity. Fact is, the buy opportunities are more likely to succeed in a market that is positively trending and should be allocated greater risk. Sell opportunities or transitional hedge themes should not have the same allocation. Even though they are valid, they are less likely to occur than an optimal opportunity. Trade techniques are enhanced using risk parameters to optimize trade tactics for trade entry and exit. JSServices defines specific trade entry tactics as either fading momentum, trading with momentum, a breakout tactic, or an exhaustive reversal tactic. The risk metrics can be used as conditional alerts to identify that the conditions to execute the tactic are true. For example, a fade tactic, by definition, the market price must be in front of the price map level, so momentum can be faded into it. The risk parameters provide the boundaries to confirm that indeed the market price is in front of the level, qualifying it for a fade entry. Risk parameters can then be used to optimize entry order placement within the acceptance zone, as well as for exit stop placement. Here's a trade entry example for a sell UP reversal. This diagram shows a textbook example of using conditional alerts to confirm that a reversal strategy is true. So we have an alert 1 below the alert distance, alert 2 above the alert distance, and alert 3 back below the alert distance of the upside pivot to confirm an exhaustive reversal. And then entry orders can be placed at the alert distance metric and at the variance metric, anticipating a reversal strategy to follow through. Here's a live example where we have market opening below the upside pivot, trading above through it, and then back below the upside pivot, generating a reversal signal where we can then place our entry orders at the alert distance and variance. After our entry, we can use the same metrics to place our stops and our limit targets. It's also nice to look at price action in confluence with metrics. So here we have a small high at the figure, other highs at the variance. Here's a high just below the alert distance, and then we have our maximum stop distance. And based on your targets, you should keep your risk reward in line and use that as additional criteria for your stop placement. Here we have the desktop. We're going to take a look at the Russell 2000, which is in a bear trend with sentiment at the upside pivot, and so we are looking to fade momentum into the upside pivot, and we'll also accept a sell reversal there. That's the optimal strategy. Here we can see the market has come and tested that level, so we had this positive trend. Anytime there's a positive trend coming into a fade, you want to be careful. It's best to wait for a break in structure or get that reversal signal. So here we have the market trending nicely, and then we get a break in structure here. Stabilizes off one of our validation levels, the CR plus, and gives us a sell opportunity to fade momentum into the R level. So here our trades get filled. And we could place our stop orders. So we have a price high here, and we have our variance metric, so we can put it above there, and then we can also put one above the alert distance. On our target limits, this would be a half APMD, full APMD, 2 APMD move. We're in an optimal theme. We're trending, so it's more likely this thing is going to follow through to the downside, and it can start trending. This is definitely the confirmation point. So we could get a reaction there. So we are going to use this price structure and this variance metric to place a limit. And then we're going to put our other limit at the downside pivot. We could do this at the variance or the alert distance, but that is our opportunity. And our initial limit is filled. Going to remove the most risk. Market is going our way. Still targeting here. We can use the price map structure to position manage this opportunity. At this point, the market is giving us some confirmation that it's going lower. We know our target's here. Market has held this validation level, so it's working negative structure like a bear trend should, and we can adjust our stop. As the market moves lower and price qualifies below the directional, this is a downside breakout. We're also getting closer to our target. So we want to keep our risk in line, basis our reward. Still anticipating this market to trend lower, make lower move lows, lower move highs. The market continues to fail, and we want to adjust our stop. We've got a market that here at price qualified below the CR minus. It should not trade back above it, and we have price in alignment with our variance metric, and we know that our target is here at the alert distance off the DP. What we don't want to do is get in a situation where we're risking more than we're about looking to make. So we want to aggressively lower our trail stop and use the price map framework to make those adjustments. And here we are trail stopped out. And we have a very quick pullback, and this is classic. So you have a trending market with sharp corrective pullbacks. And this is how you can use the price map framework to optimize your position management of an opportunity. Trade tactics can be optimized by incorporating microdynamics to make them more effective. Specifically, order book events, being liquidity shifts, resting paper, large lot orders, imbalance, and intensity of trade. Liquidity shifts. Shifts in liquidity improve timing by identifying that conditions in the order book are changing. Having a macro strategy foundation provides clarity in the microdynamics during real-time order book events. Here we have an example of a market that is in a buy-R breakout. It is broken out through the R level and confirmed a breach of the validation level, the CR plus, and pulled back to test the variance. And now we're sitting here at the CR plus, and we look at the microdynamics. We can see different liquidity shifts that have happened. So we've had the breakout signal, and then here we get a liquidity shift as the market's pulling down. Here's the top of the variance of the R level, and we get a bounce. You know, our expectation is this market's going to break out and follow through. So we have our trade vision with our macro strategy. Now we're looking at the microdynamics to improve our timing. As the market comes back up here, retests the CR plus, our validation level. We know the market needs to clear this area to really confirm that this breakout's going to be in play, and here we get another liquidity shift. So until that point when we're sitting here, our liquidity is down below the market, and then we get this liquidity shift, which is represented by the bright white. And the dark area means there's no liquidity or less liquidity. And the brighter the image on this heat map, the more liquidity there is. And here we see a liquidity shift, providing us insight that the market's ready to have another round of buying. So liquidity is kind of shifting up, which is what we want to see when we're in a breakout. Resting paper. The dynamics of the order book make all resting paper fleeting. However, the length of time that it persists can impact its reliability that it's there, along with its alignment with price and market structure. Here in our example, we've had our liquidity shift, and we also have resting paper above the market, which is just above this recent peak, and also below the market, just underneath the variance. You know, just underneath this, here we have this price structure, and we have some resting paper above that. Here's our figure, R level, and then we have resting paper below the market. So this is interesting that we can see that the resting paper is actually keying off of this price structure here below the R level. So the biggest liquidity is here. We've got liquidity resting paper here. We've had a liquidity shift, and we have resting paper here. So this gives us an idea of, you know, where's the next stopping point potentially on a bounce. It's coming up to this resting paper. If we fail, if this liquidity moves away or we take it out, where can we break down to? Well, the real support is actually resting underneath our price map level off this price structure. Here's another example of resting paper and liquidity shift where we have a market that's, you know, breaking down to support. We get resting paper to start to build up. You know, when this happens, especially when it's happening off a price map level, in this instance the downside pivot, which is our big support area, when the market moves away from it, and then it's sitting down here, and then all of a sudden you get a liquidity shift up. So this is a tell that the market might be ready to bounce, might be ready to make a move. Again, we have that macro strategy foundation. We know where we are within the structure of the market, and we're using the micro dynamics to optimize our entry. Large lot. Large lot orders can skew the order book, but should be viewed as potentially fleeting liquidity. Going back to our example, see our resting paper, and we can see some large lots have some effect here. Large lots are represented in this platform by the white hash, and so you can see this white hash here. Basically what that is telling us is that one order is making up almost the entire part of the order book, which is, that we're looking at this as potentially support. When we have a situation where there's a large lot, this support can be fleeting. This is better support down here. We do have a large lot order here, but we have a lot more liquidity that makes up this resting paper. So this is identified as really the value area, the real support area. And we look above the market at this resting paper. It was built up. This paper backed off, which is interesting. So we had the liquidity shift, less liquidity. And this paper is represented, over half the order book is one order. So if we do start to move higher and we approach this level, this may be fleeting, which is in alignment with our macro strategy. Here's another example of a large lot order. We have, resting paper below the market here. It has a large lot and the significant large lot order here. So, this can be fleeting. So as the market comes back in and presses this area, this may go away and we could see the market rotate lower. Imbalance. Order imbalance, when aligned with the price map framework, identifies and confirms opportunities so trade tactics can be applied to capture these dynamic occurrences. So here in our example, we can see an order imbalance represented by this dark area. So we have this liquidity shift. It's bright. Got resting paper bright above the market, and we have this dark area. So this tells us that the market can quickly move through this area because there's not a lot of paper. There's an imbalance. We've got liquidity here and liquidity here, and this is when you'll see those quick price movements. And so when you see the imbalance match up with structure, or they're matching up with your expectation, so where our expectation is a buy our breakout strategy, and we're looking for 2 APMDs, at least one APMD up to the upside pivot, and we have a liquidity shift and we have this imbalance, it tells us that we could have a quick shift right through this validation point, this Sierra Plus level. And we can use this imbalance and resting paper, these micro dynamics, to optimize our trade entry tactics. So we're in a buy our breakout. We know we want to enter in our acceptance zone. And we can look to the order book to see, do we have a liquidity shift? Do we have resting paper? We can use the resting paper in the order book to optimize placing our orders off of the variance alert distance along with price structure, and then we can place our stops below resting paper, below that liquidity, and use the same to make adjustments for our exit limits. Here's another example of order imbalance. We have here's the upside pivot, here's the directional. You've got, as the market's moving higher, you see the liquidity backing off, so liquidity shift away, but this resting paper stays here, and it's staying here at the figure, so at our price map level. We know this is the top of our critical range, and then we see this big order imbalance down to the directional. So this is a good opportunity when you see this for a fade, or you're getting an exhaustive signal here. Where can it go? You could have a quick rejection back through this area where there's not a lot of liquidity, back down to the directional. So it's kind of a real clear picture where you have alignment with the larger structure of the market and the micro dynamics. Intensity of trade. The intensity of trading activity is a good confirmation event for both fade and reversal momentum shifts, as well as momentum breakout trades, which can improve the timing and optimize trading tactics. Here we have an intensity of trade order book event. Initially we have this intensity of trade that signals it's an exhaustive signal at the top of the CR minus, and then we're coming down into the downside pivot. We're entering that alert distance and that acceptance zone, and we have a volume event here. We have this intensity of trade event, and we had some resting paper, it takes it out, and this paper stays here and doesn't go away, and then the market moves away from that. We're moving off the downside pivot, so we have this trade vision from the structure. Where can it go? It can go up to the directional, and we can see, after we have this event, where is the resting paper? What's sitting up here within the alert distance of the directional, and that's where the market goes, and it stalls out. And we're not getting the same intensity of trade on an exhaustive signal. We know this is the downside pivot, so more likely if we're able to stabilize here, we get this liquidity shift that could signal a rotation, at least for a retest of the directional, if not a rally up to the upside pivot. Here we have a transitional shift that's signaled by some intensity of trade. We have a market that's trending lower, and we have some resting paper here. It's approaching the resting paper, and then all of a sudden it stops making lower move lows, lower move highs with some intensity of trade, so a lot of buying, which is represented by the bigger green over the red. And then it continues to break price structure with intensity of trade. And we can see when this happens, liquidity shift. So all this resting paper goes away and backs off. So it's kind of opening the door to a move. So you've had an event, you broke structure. Now you're getting liquidity shift after an intensity of trade, and it continues to back off and more intensity. And then we see, here it backs off again. This paper doesn't go away, it stays there, and we can see that this resting paper is at the lower end of the critical range minus, which is just above the downside pivot. So we had this, a market that had broken out to the downside. You get that break in structure of that negative momentum with an intensity of trade. This triggers a kind of a short covering rally, and you can see how quickly everything backs off. It's creating a little bit of an order imbalance, and that gives you that clarity that, okay, where can we go where we can have a half APMD, full APMD segment move, and where's the resting paper aligning with structure? It's aligning at the CR minus, and that all makes sense after a downside pivot breakout, because that would be the validation point for a reversal signal. Here's an intensity of trade for a fade or a reversal signal. So we have a market that's coming into the upside pivot, so no intensity of trade. It backs off, stabilizes at some resting paper, and then we're kind of building this positive structure. We get an intensity of trade, continued intensity of trade. We've got this resting paper that's not backing off. It's staying there, and it continues to stay there. It's at the top of the upside pivot alert distance, and then it backs off from there, and as it starts to come to retest it, we're not getting the same intensity of trade. So this is a classic exhaustive signal where you get this big intensity of trade into a major structure point, upside pivot, top of the critical range, and we have supporting evidence in the order book with this resting paper that's confirming this structure. And then we get a retest of that area with no intensity of trade, and now we see we have this order imbalance as well, with resting paper kind of sticking here down at the top of the alert distance off the directional. This gives us some clarity that sales in this area, where can they go? Well, they can bring the market back down to this directional area. Trade tactic optimization comes down to observing price action within market structure in the context of the market state and underlying strategy themes to gain a competitive edge and the ability to anticipate opportunity within market metric thresholds during dynamic order book events. JSServices analytics provide a fact foundation to align trading tactics to make them more sustainable. The analytics are normalized into your daily workflow through our different application integrations, which improves consistency. Tactics are optimized with market metrics, which afford a more systematic, unified approach that is applicable across all asset classes, and enhanced by incorporating real-time order book events. Thank you for your time. My hope is that this presentation has improved your market state awareness and offered insight on how to optimize your trading tactics. The JSServices.trade website contains additional content to improve your understanding of our methods and links to demo our applications. Please send inquiries and questions to info@jsservices.com. I look forward to working with you.